Here in this video, we are going to get into how the collateral that is behind backing the 25% short interest that AMC has is starting to get chipped away over the last couple of days, and how the rule changes throughout 2022 that we've seen with the DTCC as well as the NSCC can and likely will give you a rally in AMC stock, especially when the stock starts to get bullish again. And that actually happened today. So this is actually a video, or a topic of one of the videos, I should say, that we talked about over the last couple of days, but it was closer to the end of the video, and I don't think people fully understood the information that was provided, and I likely did not present it in a way that was fully understandable, or did not cover the topic long enough for everyone to realize what was being said. So we're going to dive into it here in this video. This video is very crucial to watch if you own AMC, if you're down on AMC, if you're looking to buy more AMC, or 8 for that matter, and or you want to see a short squeeze in this stock. So let's get into it, guys. We're going to cut straight to the chase. Hit the like button, subscribe to the channel, all of that good stuff. Now, on top of that, if you guys want to come join the trading community, we did put out a bunch of trades today that you guys really want to at least have background knowledge on, because these kind of trades can and will affect not only the specific trade, but the markets as well. And these are earnings trades, high risk, high reward kind of trades. If you guys want to be a part of it, link down below in the description of this video. Nonetheless, let's talk about it, guys. So let's start with what happened in 2021 as well as 2022, and this specific rule change that I think is very important that you guys know in regards to what we are seeing today. So I believe this was NSCC or DTCC rule change. It's hard to get the numbers straight with all of these. Regardless, this happened April 29th, 2022, so less than 1 year ago. So you guys might think this was like a long time ago. Actually, it wasn't. This happened less than a year ago, so very relevant to what we are currently seeing. Now, specifically, I should say, with AMC, with GME, with these other stocks that can move a lot, the requirements to short these stocks are a lot different than, call it, an Apple or even a Tesla, because those stocks, they're so stable, relatively speaking, compared to like an AMC or GME, that the risk that you're going to lose money shorting those companies is not very high. The odds that we go back to a risk on market and the markets rally 20% from here, more unlikely than not. Whereas AMC or GME, for that matter, a recent example, GME had earnings, first profitable quarter in 2 years, stocks up 45%. That's not going to happen to a Tesla. That's not going to happen to an Apple. So the requirements are a lot more to short stocks like AMC. After all, look at Archegos, look at Melvin Capital, look at the various other hedge funds that went completely out of business, that caused banks billions and billions of dollars in losses shorting AMC. That's because a stock can only go down so much, but a stock can essentially rally to infinity, right? I think that is well defined, and I think everyone is on the same page when it comes down to that. Now, what actually happened in this rule change? Well, it was deposit or collateral haircuts, right? So when you take on a short position in AMC, call it, if you want to short $100 million worth of AMC, well, depending on what kind of collateral you're putting up, you're gonna have to put more of that up, essentially more than the already more than you would have had to do otherwise, because AMC is just risky. So essentially you got to put up more collateral than, hey, if you wanted to short an Apple or a Tesla, and then on top of that you got to put up more collateral on top of that. So it's like 2 extra layers of collateral that need to be put up on AMC. And when those collateral levels move around, like we'll talk about here in just a minute, that's where you can start to get some hard decisions that hedge funds have to face. Now, if you look at the security types up here, and the collateral haircut percentages are over here, interest-bearing United States Treasury securities. No wonder it's only a 2% haircut. If you're going to put up treasury bonds that have essentially zero risk held to maturity, right? You had to get a 2% haircut. So even that got a slight haircut. And bonds continue on for really this whole chart. Treasury securities with excess of 5 years until maturity got a 12% haircut. Now, this is interesting. It says MBS issued by a U.S. agency and U.S. government sponsored enterprise. All other GSEs not under U.S. government sponsorship, AAA to AA, or AA, or AAA to AA, had to get a 7% haircut. MBS issued by a U.S. agency and U.S. government sponsorship enterprise had to get a 100% haircut. And other GSEs not under U.S. government conservatorship under AA rating had to get a 100% haircut as well. And this is where the problem comes in with AMC. Now, this is nothing new, but in this market environment where you're starting to see the collateral actually taking some hits here, think the treasury market, right? You've seen that happening over the last year, so that's not really a new thing. But more specifically, large tech. So hedge funds, right? They hedge out the markets. A hedge fund in theory is supposed to make you, call it 10% every year. They kind of underperform the history of the stock market. But even in the bad years, they're supposed to do better than the markets. That's the point of a hedge fund. Well, when you are a hedge fund, you at least have to have some correlation to the markets, right? Because markets historically perform better than a hedge fund. So you have to be somewhat weighted to the markets. The way that you're weighted to the markets is investing in Apple that controls 11% of the NASDAQ, Microsoft that controls 8% of the NASDAQ, slightly smaller ratios for the S&P, but you get the point there. That is almost 20% of the NASDAQ alone in those two names. When you factor in Tesla, Nvidia, Google, Amazon, Facebook, you're looking at another 20+% of the NASDAQ. So all in all, that's like 45% of the NASDAQ right there. You have to be invested in those names. Now, these hedge funds that are invested in those higher quality names, we'll just call it that, higher quality fundamental names, well, to be in these short positions, they had to deposit obviously money, right, to be in these short positions, but they had to deposit collateral because remember, a stock can give you infinite losses. If you short that stock, can literally make your firm go bankrupt. Whereas if you bought the stock or were on the other side of that, you can only go to zero, right? So you need more collateral. The higher AMC tends to go, the more collateral you need, or the riskier AMC becomes if you're short in that name, right? If more risk is that, hey, AMC's going to be more volatile, it's going to go higher from here, you're going to have to see more collateral put up on top of that. Now, I think right now with AMC, there's probably the most uncertainty you have seen in a long time. And I think that's very obvious in the cost to borrow rates. And we'll also give you guys a rundown of the Ortex stat as well here in this video in just a minute. But main point here is that the collateral that is currently pledged to AMC is taking some pretty big hits. If you look at something like Meta, they are falling yet again today after falling yesterday and down about 1.63% here today. Was down about 2%, but more importantly, I think a lot of collateral behind AMC is really pegged to Apple, because Apple is your bread and butter. You have to own Apple pretty much if you're a hedge fund or a money manager. Anyone that would be short on AMC really has to own Apple. That seems like the logical place or logical collateral to put up in an AMC short position, because there's not a whole lot of risk to Apple. It's not like you're pledging collateral in a, I don't know, second tier name or even larger company that could still fall a lot. Apple's pretty cushioned, right? So I think it's safe to say a lot of collateral is probably Apple. That would be the name that I would pledge as collateral, that when you pledge as collateral, you're not going to sell it. And a lot of people just buy and hold Apple because, again, the indexing factor. If you're a hedge fund, you have to somewhat mirror the markets. Let me tell you, if you're a hedge fund, markets are up 15% a year, you're up 5% or you're negative, that's not going to look good, right? So again, you got to somewhat mirror the markets. Now, Apple specifically, this one is interesting. You have seen an over 20% rally from the lows, about a 28% total rally from peak to trough right here. And you've started to roll over the last 2 days, and you're starting to get more people that are more bearish on Apple than they have been in a long time here. So if this does continue, and that's the main key here, if we go back to this whole, techs going to the moon kind of rally that we have seen since the start of 2023, well, then this video is probably going to mean very little. If Apple and these other names continue to fall, and AMC continues to rally, that's where this could be more prevalent information than ever. For an example, Apple yesterday fell 1.23%, which this is almost a $3 trillion company. 1-2% drop is pretty big market cap wise. So they fell 1.23% yesterday. They fell so far on the day today 1.12%. So all in all, like 2.5%. Almost. AMC yesterday rallied 1.79% and is up 3.5% right now. So you can start to see, in a weird way, the worse and worse Apple is starting to do, the better and better AMC is starting to do. I don't think that is a huge shocker here, and it really goes for the whole technology sector, not necessarily for Apple. Apple's an easy one to pick on, just because I just don't think this is the year for Apple. I don't think Apple's a good investment right now. It's pretty clear to see when you actually break down these things, look at them, like put the charts together, look at the price action, use a little common sense here. You could very shortly be facing a collateral crisis. Now, let's go ahead and get into the Ortex data before we wrap up this video, and I hope this video is a little bit more conclusive and helps you understand a little bit more what is currently at stake here and what's currently happening, because it's not like we have small numbers here, right? The live short interest on free float is 25%. You have not been this high in a very long time, like a super long time. The amount of shares currently sold short, a live estimate of 129 million. Cost to borrow numbers continue higher here today. Cost to borrow average of 386%, cost to borrow max 435%, and cost to borrow minimum of 0.35%. Interactive Brokers short availability has about 35,000 shares that are currently available, with a cost to borrow rate of 269%. This is even up about 18% from the reading that we just got about an hour ago at 251%. So all signs are starting to point to, one, extreme levels of volatility with AMC. AMC having a direct correlation between Apple and tech falling and AMC rising, and ultimately the collateral crisis that is likely starting right now. So I think a risk to reward basis here makes a whole lot of sense. For one, some long dated AMC options, which I am looking at extensively, doing a lot of due diligence on here today, as well as averaging down in your positions. If you are confident on AMC, if you are investing money that you are willing to lose, if worse comes to worse and AMC were to crumble and fall to zero, you could sleep at night and your family wouldn't go without a meal, right? These things are self-explanatory, but need to be reminded of. And I think, especially right now, I feel like I could just rant forever on this specific topic as well. A lot of people have given up on AMC. A lot of people that you watched a year ago that talked about AMC never really had the confidence to begin with. That's why I can sit here and make confident claims about what I'm saying, because I've been in this for a long time. I've always had confidence in this. And right now, I think the less people that are talking about AMC gives it that much more oomph once the event actually happens. It's kind of like Meta or Tesla that did not do well in 2022, but they get the first good earnings. You get upgrades. You get from neutral or negative weightings from analysts. You start to get positive ratings and people increasing their price targets by 50%, and oh, everyone was wrong about this company, right? You get the idea. When more and more people are negative, it just sets you up for that bigger upside move. And dude, look at AMC. How can you deny this? Apple now down 1.2%, lower than what we just said. I think it was only down like 1.10%. Still, about a 0.1% drop here in the last couple of minutes. AMC stock is now 5.38% in the green today. Come on now. Come on now, dude. Just give me a break. If that doesn't say it, then I don't know what else will. Hopefully, this information resonates with you guys. Hopefully, it makes some sense, and hopefully, we broke it down in a more clear, concise way to understand. But that is how the collateral crisis is here, if not very shortly will be here, and how margin calls could be right around the corner. That's going to do it. Like I said, if you guys want to come trade with me live in real time, link down below in the description of this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for watching, and I will see you in the next one.